Hello friends, today we are going to discuss the section 5050 of the Income Tax Act 1961. Section 50 of the Income Tax Act talks about the computation of a capital gain in case of a depreciable asset. Friends, in case of a depreciation asset, whatever the actual cost at the time of a purchase, you can claim the depreciation as per the rate prescribed under the Income Tax Act. Section 32 prescribe the provision relating to the depreciation under the Income Tax Act. So, in case of a depreciable asset, the WDV of the asset is reduced on each and every year with the depreciation amount. So at the time of the transfer of such depreciable asset, capital gain shall be leviable. However, the provision relating to the mode of computation which are given under section 48 as well as the provision relating to the cost of acquisition which are given under section 49 will apply with certain modification which are given under section 50 of the Income Tax Act. So in case of a capital gain on a depreciable asset, the section 48 as well as the section 49 will apply with a certain modification. One most interesting part of this section is this section will override section 2 subsection 42A. What is the section 2 subsection 42A? Section 2 subsection 42A talks about the definition of a short term capital asset. It talks about that if any asset is held for a period not more than 36 months, means it is held up to 36 months, then it can be termed as a short term capital asset. However, in case of a listed shares, the period of 36 months will be replaced by 12 months. So in case of a listed share, if asset is held for not more than 12 months, then it can be considered as a short term capital asset. In case of a shares which are not listed, further in case of a land or a building, the period of 36 months is reduced by 24 months. So if it is a land or a building or a shares other than listed, then if it is held for not more than 24-month period, then it can be termed as a short-term capital asset. So section 50 is override the section 2 subsection 42A. So if anything contrary in a section 2 subsection 42A with regard to section 50, then section 50 will prevail. Now we will understand this section 50 provision with the help of a one case study. Same for example, if you have sold the depreciable asset and if a full value of consideration is a greater than WDV at the beginning of the year plus actual close plus expense incurred on a transfer, then such excess will be termed as a short term capital gain. So here the full value of consideration you can determine very easily at the amount which you have sold. You can also determine the expense incurred for the purpose of a transfer. So full value of consideration less expense incurred for the purpose of transfer. So it will be the net value of a consideration. Now for the purpose of a cost of acquisition, you have to determine the WDV at the beginning of the year plus actual cost of asset acquired, which whatever the new asset is acquired, actual cost is added to the block. So full value of consideration is reduced by the expense on a transfer, further reduced by the WDV as on the beginning of the year, and further it is reduced by the actual cost of asset acquired. If there is a excess balance, then such excess balance will be termed as a short term capital gain. Same for example, suppose full value of consideration is 100, WDV at the beginning of the year is 50, actual cost of asset acquired during the year is 10, and expense in connection with the transfer is 5, then 100 minus 50 minus 10 minus 5, so the answer is 35. So it is a positive answer, so it will be termed as a short term capital gain. Now next case is, first case is full value of consideration is higher than the WDV plus actual cost plus expense on a transfer, then it will be termed as a short term capital gain. Next case is if there is a same, for example, 10 or more asset in the block, and if all the asset of the block are sold, same for example 10 asset in a block and all the 10 asset are sold, then block is to be exist. There is no block for this asset as all the asset are sold. Then also excess or short term will be termed as a short term capital gain or a short term capital loss. Same for example, if a full value of consideration is 100, WDV at the beginning of the year is 70, actual cost is of new asset acquired is 30 and expense in connection with a transfer is 5, and suppose all the assets are sold, then the answer here is a negative, so it will be termed as a short term capital asset, short term capital loss. So here there is a two case. For in a first case, the full value of consideration is higher than a WDV actual cost of asset acquired plus expense incurred on transfer. In a second case, all the asset of a block are transferred and block sheet to be exist. So in a two case, the computation of a capital gain in case of a depreciable asset section 50 is applicable. Now we will consider this. What are the conditions? One of the two conditions must be satisfied, that is block sheet to be exist, that means all the asset of block are sold, or full value of consideration is greater than the cost of asset, that is the WDV plus actual cost of asset acquired. Further, expense in connection with the transfer is also reduced from the full value of consideration. If answer is positive, then there will be a capital gain as per section 50. If a block exists, that is the full value of consideration is less than cost of asset, then cost of asset minus full value of consideration will be treated as a WDV, and on this WDV depreciation can be claimed. Now we will understand this with the help of one example. Suppose ABC and a company hold 6 machines as on 1st April 2020. WDV is 25 lakh. As on 1st November 2020, a new machine is purchased worth rupees 5 lakh. Old 6 machines were sold for 28 lakh. Determine the depreciation or a capital gain. So first you have to determine the WDV at the beginning of the year, that is the 25 lakh. Add asset acquired because it is added in the block of asset. So asset acquired as on 1st November 25 less sale of a asset. So any money received on a sale of asset will be reduced from the block. So 28 will be reduced. So what will be the depreciable value? 25 plus 5, 30 minus 28, the depreciable value is 2. Now here it is mentioned that old 6 machines were sold. That means all these 6 machines were sold. However, the new machine which was purchased on 1st November, it is still in the block. So these two depreciable value represent the WDV for the purpose of a new machine, and the new machine is purchased and used for less than 180 days because it is purchased on 1st November 2020. So the depreciation will be 50% of the original rate. So 2 multiplied by 7.5. So depreciation will be 0.15 and the remaining WDV will be 1.85. I hope you will understand this. Now consider this: if the machine which sold in a 28 lakh in the last example, however if 28 lakh, if machine are sold for rupees 35 lakh, then what will be the answer? Here the full value of consideration is 35, cost of asset, that is a WDV as on the beginning of the year, that is a 25, and the asset acquired on a 1st November, it is a 5. So here the cost of asset, that is a WDV at the beginning of the year plus addition of the asset is 30. However, the asset is sold for a 35. So here full value of consideration is more than the cost of asset. So it will be termed as a short term capital gain. So here 5 will be termed as a short term capital gain. Now, what if all the machines of the block are sold for 29 lakh? Here all the machines are sold for a 29 lakh. That means old 6 machine plus 1 machine new purchase. So all the 7 machines are sold. So full value of consideration is 29 lakh. WDV as on the beginning of the year 25. Asset acquired cost is 5. So the answer is 29 minus 25 minus 5. So answer is minus 1. So it will be termed as a short term capital loss. This is the original bare provision of a section 50. So I will read for your better understanding. So the section will start with the wording that notwithstanding anything contained in a clause 42A of section 2. We have already understand that section 2 subsection 42A talks about short term capital asset. So if anything given contrary in a section 2 subsection 42A, then section 50 will prevail. So notwithstanding anything contained in a section 2 clause 42A, where the capital asset is an asset forming part of a block of asset in respect of which depreciation is allowed, then the provision of a section 48 and 49 shall be applied subject to certain modification. So here the full value of consideration accruing as a result of a transfer within the block of a asset during the previous year exceed the aggregate of the following amount: expenses incurred in connection with the transfer WDV at the beginning of the year and actual cost of a asset acquired during the year. If full value of consideration is more than these three, then such excess shall be deemed to be the capital gain, and such capital gain shall be the short term capital gain, and it will be treated. So the depreciable asset is always treated as a short term capital asset. So this is the reason that the wording of the section is started with notwithstanding anything contained in a clause 42A of section 2. Now the second condition is where any block of asset cease to be exist. That means all the assets of the block are transferred during the year. The cost of acquisition of a shall be the written down value of the block of a asset at the beginning of the year plus actual cost that is acquired during the year, and the income received as a result of a such transfer shall be deemed to be the capital gain. So if all the assets are transferred, that is block said to be exist, so the WDV plus asset acquired will be the cost of your acquisition less full value of consideration. If answer full value of consideration is more, then it will be termed as a capital gain. So this was the discussion with regard to the section 50, that is the computation of a capital gain in case of a depreciable asset. Thank you.